Okay, the formula is account receivable divided by sales. You multiply with 360 days, which give you the average collection period in days. Okay? In days. Okay, it will measure the average days taken by customers to pay. Okay, but using the ACP, we could identify how the company, okay, collect their debts, okay, from the customers. How the company collect their debt from the customers. Whether they are a good collector or they can sell but they cannot collect. Okay. For example, the policy of the company stating that it should be 30 days. Okay. Okay. The sales should be 30 days. The credit sales should be paid within 30 days. But if the ACP ratios says that the company ACP is actually 65 days, it is actually performing below their expectation. Okay, below the expectation. Okay. The shorter the period means the better. Okay. The shorter the ACP, the better is the ratio. Okay. It means that you reduce, you reduce the time that is being given to the customer to pay to you. Okay. Instead of 60 days, you reduce it to 30 days. Okay. The shorter means the better, because you can get the cash to roll it back to buy other products or to buy your raw materials. Okay. And C, average payment period. Okay, average payment period formula is account payable divided by purchases. You multiply with 360 days. Okay. Okay, this is also the same as the collection period. Okay, but instead of measuring the collection, the ability to collect, it actually measure the ability to pay to your suppliers. Okay. Okay. How many days you could pay or you should pay to the supplier. So it measures the average day taken to pay suppliers. The longer the period means the better. So you see, when we want to collect money, we want it fast. Okay? We want to collect it fast. But when we want to pay, we try to delay as long as possible. Okay? Right? Because we can get free credit from delaying the payment. But higher average payment period does not mean that you are actually good. Okay? Does not necessarily mean that you are good. Because sometimes when the supplier look at your average payment period, they will see that you are not a good paymaster. So they don't want to supply to you. Okay? Because they say, if I sell to you, to the companies, okay, I will not get my payment as soon as possible. Okay? Right? Okay. So sometimes it is very subjective. Okay? The rule of thumb is there, but it is very subjective. You have to look beyond the figures. You have to look beyond the figures. You have to look at the other aspects of from the figures. Okay? And then we have total asset turnover. Okay? And the formula is sales divided by total assets. Okay? So basically measure the efficiency of using assets to generate sales. Right? For example, if you have 1 million assets, okay, and then you have you generate 2 million sales. So when you use that formula, sales divided by total asset, you get 2 times. Okay? Turnover you use times, right? Turnover. So it means that one asset will generate you twice as much from your twice as much of your sales. Okay? Okay? So one asset will generate 2 sales, for example. Okay? So this is the measure. Okay, any question before I proceed? Lisa. Any question? Oh, there are two Lisas here. No question. Firdaus. No questions. Arni. Anri. No question. Okay. Not Arni's last three. Okay, sorry. Slip of the tongue. Okay. Now we continue on to the next ratio, which is the leverage ratio. Leverage ratio, or in other words, we call it debt ratio, or the word, not debt ratio. We call it the financial leverage ratio. And leverage ratio, debt ratio, okay. We have another debt ratio inside this ratio. Okay, we can call it debt ratio. Okay, we have the first one. We have debt ratio itself. Okay, the formula is total liabilities divided by total assets. So you simply take the total liabilities, then you divide it by the total assets. So it measures the proportion of the assets financed by debts or borrowing. So how much is your asset being financed by your debt? Okay, so then you can get the debt ratio. Okay, the higher the ratio means that the higher the leverage, or the higher the risk, okay, for the company. Okay, normally 0.8 ratio will show that that company is actually a bankrupt company. A ratio of 0.8, okay, means that the company is a bankrupt company. Okay, because 20% of the total asset, the remaining 20% is not sufficient. Is not sufficient to contain the business. 20% of assets from equity. 80% are from debts or from bank. So 80% shows that the company is actually facing financial distress, and also probably is having legal action being taken by banks. Okay. Okay. The next one, times interest earned. Okay. Time interest earned is actually measure the ability to pay interest on borrowing. Okay. The bank will always look at this figure to see whether the company is able to pay its interest on borrowings. Okay, because the bank lend out money to the company, and the loans will be charged interest, and they want to see whether the company is able to pay or to service the interest. Okay, so the formula is EBIT divided by interest expenses. Okay, the lower the ratio means the higher the risk of insolvency. Okay, means that the lower the ratio means that the lower that you will be able to cover your interest payment. Okay. The next one is fixed payment coverage ratio. Okay. Okay, it measures the ability to meet all fixed payment obligations. Okay, in this case, companies always have fixed payments, right? In operating their business. Okay, fixed payments such as the lease payments, okay, right? They have to pay it monthly, right? It is fixed. So let's see to measure whether the company is able to meet all its fixed payment obligation. Okay, the formula is EBIT plus this payment, you divided by interest plus lease payment plus PP. I forgot what is PP. Principal payment plus preferred stock dividends times with 1 divided by y minus t. Okay, this is the formula. Okay, the next one. Profitability ratio. Okay, I've mentioned before that profitability ratio measures on the profitability of the company. Okay, we have gross profit margin, we have operating profit margin, we have net profit margin, and also we have return on total assets. Okay, gross profit margin measures the percentage of gross profit out of sales. You simply take gross profit, you divide it by total sales. Okay, take gross profit, divide by total sales. These figures is taken from the income statement. Okay, right. The higher the ratio, means the better it is. Okay, higher, better. For profitability, higher is better. Profitability, higher must be better. Higher profit, better. Okay, operating profit margin. Okay, simply says that how many percentage of the operating profit out of sales. You simply take operating profit, you divide it by sales. Okay, ataupun EBIT divided by sales. And then before interest and tax divided by sales. And it's also the same as the gross profit margin. The higher the ratio is the better. And then we have net profit margin. And this is also the same. We just take net profit divided by sales. Okay? So it will represent the percentage of the net profit margin. Okay? And this is also the same as all other ratios in the profitability ratios. The higher the ratios is the better. And then we have return on total asset. Okay, return on total asset equal to net profit after tax, you divided by total assets. Okay. So measure the overall efficiency of assets in generating profit. Okay. So whether we will evaluate whether our assets is efficient or not. Okay. In generating profit. Okay. The higher the ratio, also the better. Yes. So for profitability, higher is better. For leverage, lower is better, right? For leverage. For liquidity ratio, the higher is the better. And for activity ratios, it depends on the ratios. But normally the higher is better. Okay. And then we have also return on equity, earning per share, and price earning ratio. Okay, return on equity, the formula is almost the same as return on asset, except that we divided the net profit after tax with equity. Okay, return on asset, we divided the net profit with asset. It's raining outside. Okay. So imagine the return earned by the shareholders. Okay, so this ratio is important to the shareholders. Okay, important to the shareholders. Now the higher the ratio means higher return to the shareholders. So you can see that in profitability, the higher the ratio is the better. Right? Now let's see the next one, earning per share. Okay, the formula is net income you divided by number of shares outstanding. Okay, so we measure the return of per share, and this is also the same. The higher the EPS, okay, means that higher return to the shareholders. Okay, so higher EPS is preferred. And lastly, we have the price earning, not last, we have another one after this. We have price earning ratio. Okay, price earning ratio, you simply take the earning per share, okay, that we have derived before, and then we'll take the market price of the share itself. Okay, so what we do is that we'll take the market price of the share, then we divide it by earning per share. Okay, now we will show you the higher the ratio is, that the higher the level of confidence of the company. Okay, the higher ratio, the higher the confidence of the company. Okay. Another ratio is the market book value ratio. Okay, market book value ratio. That one is in your book. Okay, so in your book, page 66. Okay, page 66, you have market CAM book or MB ratio. Okay, for this ratio, you have to calculate the book value per share of common stock first. Okay, the formula is common stock equity divided by number of shares of common stock outstanding. Okay, in other words, we call it net tangible asset. Okay, have you heard about NTA? Okay, it's the same as NTA, and net tangible assets. Okay, NTA, right? In accounting, right? In finance, we call it book value per share of common stock. Okay, in accounting, you call it net tangible assets. Okay, it's the formula, the result is the same, except the formula that you use in accounting is different. Okay, the formula that you use in accounting is different. Okay, basically in accounting you use what? Total asset minus total liabilities. Okay, then you divide it by number of shares outstanding. Okay, actually it's the same. We use common stock equity divided by number of shares outstanding. What you will get after you take total assets minus total liabilities? Common stock equity, right? Okay, you get equity, right? Okay, it's the same. The next one is market book ratio. Okay, the formula is market price per share of the common stock itself. You divide by the book value of the share of common stock. Okay, so market price divided by NTA. Okay, market price divided by NTA. So the market book ratio is actually saying that every, for example, you get $1.40, right? For the example in the book, it says that the investors are currently paying $1.40 for each $1 book value of the common stock. Okay. Now let's see the ratio analysis example. Okay, this is more theoretical. Sometimes you cannot get the theoretical part. Okay, but you have to do the example and also the calculation part. Then only you can get to understand the financial ratios. We have Butler Company. Okay, page 68. Okay, just open to Basket Company. I don't want you to open to page 68 yet. Just open to page 43. Open to page 43. 43 and also 45. Okay? 43 and 45. Okay, these two pages, okay? You will be just looking at these two pages. Right? Then you can derive the ratios. Okay? In page 68 is the answers. Okay? We'll try not to look at the answer first. We'll try to do it ourselves. Then only we look at the answer. Okay. Now we have these two pages. These are the information that we will use in deriving the financial ratios. Okay, let's go one by one. Let's go one by one, starting from liquidity ratios. Liquidity ratios. Now I would like you to find the net working capital. Amount for net working capital. What is the amount for the net working capital? Okay, you can open the balance sheet, right? Open the balance sheet. What is the formula for net working capital? So current assets minus current liabilities. Okay, how much do you get? Okay, for year 2003. Please find it for the year 2003. How much do you get? 603. Yes? 603. Okay. So you can get do you know how to get these figures? Everybody? Marif? You know how to get net working capital? Okay. Now let's try the current ratio. Okay, what is the formula for current ratio? Okay, I'll call your name. Nur Adila. Nur Adila. What is the formula for the current ratio?